Well, hello and welcome to this Money Control live stream. I am Nandita Khemka. Well, what you're seeing across the screen today is a sea of red. And no points to guess, it has been led by a Fed, it's a Fed fuel sell-off, and it has been led by the hawkish comments that have been coming in from the US Federal Reserve Chairperson Jerome Powell. Well, he had said that we will be looking at high interest rates for some more time to come, and clearly the focus is on inflation, and even if that comes on the expense at the expense of growth. So to decode what the Fed has said and the impact on Indian markets and what investors should be doing right now, I'm joined by in fact, our senior consulting editor N. Mahalakshmi to decode what the Fed comments mean for the Indian markets and what the investors should be doing at the current juncture. Good morning, Mahalakshmi. Thanks a lot for joining us. Tell me, given the fact that Fed has reiterated the fact that the focus is very much on inflation, and that he doesn't really mind giving up on growth or compromising on growth when it comes to reining in high prices. Do you expect that the Fed will hike rates by another 75 basis points in the September meeting?
Suspect so, Nandita. I think it's pretty much, I look at it as a continuation of what the Fed has been doing and saying for the last few months. I think the market slightly misinterpreted the move as very dovish. Anybody who interpreted as dovish was not really right, because the economic environment is such that Fed itself has said that it will watch economic indicators and data to chart its further course of action. And this is Powell's comments in the Jackson Hole Symposium is only to sensitize the market to what lies ahead, because there is somehow this presumption that if there is a recession, then the rate hikes will stop, and all of these kind of notions. I think the Fed is just doing its job of conveying to the market, well, inflation is now a priority, and unless the data shows us very clear signs that we are going to get closer to our targeted level, which of course is very, very far away from they're not going to let up this. I would think that their strategy is to front load, which is why they did a 75 bips hike last time. And I think another 75 bips, they said we could stop in the last FOMC meeting. They did indicate that we could stop a little earlier if economic indicators are favorable, but I wouldn't even read too much into it. I think we have to watch and look at data, and that's what the Fed is doing, and that's what we as market participants should also do.
Sure, sure, ML. When you talk about data, we saw two straight months of contraction when it comes to the US GDP. And we have also seen the job market cooling off a bit. Now, do you think a recession is imminent in the US?
I think that is, again, taking cue from the FOMC meeting last month. What Powell said was that the path to soft landing is really narrowing, right? Which means a recession is highly likely. But at the same time, they might want to do. He also indicated that they might be able to navigate it to soft landing. And even now, if you look at data, I think there is some surveys show that there will be about 300,000 payroll hike this month too. It's lower, obviously, than earlier, but still the unemployment rate is at 3.5%. It is not really letting up, and and let's also understand that this whole trade-off is between growth and inflation. So we shouldn't be looking for a world where we are able to rein in inflation and there is no impact on growth. And that is exactly the comment that came out even on Friday, right? That we should be, businesses and households should be willing to take that pain, because this, navigating this whole economic environment is going to be challenging and we can't escape that.
Right. So high inflation and high interest rates, do you think that is the new world order?
Oh, absolutely. Oh, because right now, if you see, I think we all have a whole generation of investors who have come in the last 10 years, don't have a sense of history. Because in 2000, pre-COVID, in 2017-18, you had about 2.5% Fed rates, right? And the last time you had higher than that was really in 2007, where you were at 5.5% Fed rate. And what
Hmm.
we are seeing now, which is near zero to now, of course, 2-3%, is really, you've come off the charts significantly. And this interest rate cycle, I did an interview with James Grant last week, where he again pointed out this whole thing that interest rates are in a 40-year cycle. We are at a 40-year low, and this is going to be a new period. And this a part of this inflation, of course, is supply chain constraints and all of that. But this is also a structural shift that we are seeing. I think the market is not really appreciating this as much as it should. I'm not
Right.
saying that this we are set for a collapse. Some people do believe that we might be set for a big collapse, and there are a lot of bears both here and US who are calling doomsday. But I would think that as this structural shift happens, it will have long-term implications for equities, which means that at every level, for example, the first casualties have been tech sector, right? Because they were totally
Yeah.
super
Indian
richly
tech sector
valued.
was down somewhere around
That
4% at
yeah,
start today,
those
right?
were funneled by the zero interest rate and 1% interest rates. But at every level, since we have not seen elevated interest rates in more than 10, 12, 14 years, we're at every level, we will see disruptions in business models. We will see financial challenges cropping up. Right now, we are unable to see what is that time bomb. But at every level, there are going to be some businesses that are going to go through tough times because of higher cost of capital. But so it's going to be painful for a while for the US. It may not be the same for India.
Okay, so see, when you come to the markets, we saw like a knee-jerk reaction in the US markets, Dow tumbling 3%, Nasdaq tumbling nearly 4%. Even today, Asian markets were somewhere near two-year lows. And look at the Dow futures; they're also like hinting at more sell-off when it reopens today evening. But when you look at the Indian markets, they open somewhere on 2% lower, and they are somewhere on 1.5% lower or thereabouts. But do you think this entire market reaction is a knee-jerk reaction because the Fed has already been saying that it's inflation over growth? So what do you want? Do you expect this to settle down, or do you expect the sell-off to continue for some time to come?
Samrita, in this kind of environment, for every action there is a reaction. For no action, also there is a reaction. That
Right.
is because the markets, and the reason is that there are a lot of fence sitters in this market. I think the entire market is confused. All participants are confused, and there might be some people who have very staunch views, but majority of the market is still wondering whether this is, interest rates will really go up or not. And there are others who believe that it won't go up very steadfastly, right? And that is why every time there is a statement or an economic data, there is such a huge reaction to it. And I don't think this trend is going to change. But like I
Hmm.
said, I think this is a structural shift that is going to happen in interest rates and the inflation scenario, and this is going to take some time to play out. uh,
Yeah.
uh, Sorry, I'm forgetting what is the pointed question you asked. I think it's going to take some time
Some
uh,
time.
to play
Right.
out.
Okay, so should investors look at buying into this dip? Because Sensex had reclaimed 60,000, prices were again becoming elevated. So now, do you think is the time to look at those select quality stocks that you want to pick up? Because it's a correction that has happened last week, started last week rather, and even Uday Kotak has said that you can expect a sharp correction going forward, given the tone that Fed has adopted.
Correct. So that's what I'm saying. So there are people who have strong views in terms of where the market is. I haven't heard anybody saying we are in for a sharp up move, right? Anybody
Hmm.
who is
Sure.
talking about a sharp move is only talking about a downside. I think largely either the market should, head lower and there should be a slow period of consolidation, or it could, head lower in a slightly, in stronger bouts of volatility could happen. But Serco, since the larger direction of the market is downwards, I would
Hmm.
think that it would be very risky if you're a trader to be trading on the opposite side. And if at all you want to do that, then you have to be very, very particular about your stop losses and very disciplined in your
Hmm.
strategy. As an
Right.
investor, I would think there is no hurry to go out there and buy. And
Hmm.
it's not that these dips are going to go away. This is going to stay for some time. I would think that I would, if you are a long term investor, you can wait it out, you can nibble wherever you find individual stocks at very attractive valuations. You can start to accumulate them with,
Hmm.
keeping aside enough kitty to be able to buy more if the prices crash further. Because
Okay.
however good a company may be, however good a stock may be, when there is an avalanche in the market, nothing will be spared. All stocks will go down, and we need to be prepared with money at that point in time to really be
Sure.
able to take advantage of the prices that you will see.
Right. Emil, my last question to you is we had seen foreign investors turning sellers into the Indian markets somewhere around November 2021. And since then, they've been sellers for the last 8 months. And just this month, we saw them returning to the Indian markets. In fact, month till date, they have pumped in somewhere around $4.5 billion or thereabouts. But of course, with the kind of tone that Fed has adopted, the ultra hawkish tone, do you expect them to once again turn into sellers?
So I think this is not a very simple question to answer because, like I said, I think the structural story in the U.S. is going to be one of higher rates and higher inflation. But let's remember that U.S. has been the fountain of capital for the rest of the world, and everything is determined by how that economy does, how the rates are set up is out there. That is what determines how flows come into India. There is definitely, as you can see even from the data, that our markets have been lot more resilient, and we have also gathered a disproportionate share of inflows post COVID. And while that trend will continue, you can't say for sure that this means that the FIIs have come in for good and they're not going to go back.
Hmm.
Whenever there are bouts of volatility in the market, money will move out, and but in a systematic way. I don't think there are very high risks to Indian markets, but whatever is, whether it is global inflation, import, those things are going to remain challenges. But the domestic story is still strong, and please let's not forget that India is not very new to a 7% inflation, right? Of
Yes.
course, WPI is far higher, and at some stage that is going to get transferred to CPI also. But overall, it's not as big a shock to have a 7-8% inflation for India as much as it is for the US. So we will be little more resilient, but you can't rule out the possibility of outflows from foreign institutional investors in this kind of environment.
So that's the word. So Indian markets are resilient. The story is intact, and if you're a trader, you should look to keep tight stop losses, buy stocks, quality stocks. In fact, on dips, but then keep money at hand to kind of jump in when the correction gets a little more severe. Thanks a lot for joining in, Mahalakshmi, and helping us navigate or understand how this Fed commentary will impact markets and what investors should be doing at this juncture. So thanks a lot for tuning in. Stay tuned to Money Control for more news and updates.